Hey guys, and welcome back to another video of optimization strategy or strategy optimization, making our strategies much better and profitable for the long term. Now, in the previous videos, I've been talking about what to look at, what to backtest, and what to trade. In the last video, I shared about how I look at indices and how I've toned down, and the research I'm doing and what I'm trying to figure out of the indices. There's much more to learn, and I'll continue sharing with you guys this stuff. But as I'm learning, I also want to bring you people along with me so that you can learn as well alongside. So today, in the last video I said today I'll share a couple of things that I want to look at, and today I want to talk a little bit about key levels with regards to indices and commodities, what I focus on. Why is it important to look at this stuff? Most of you come to the market and start trading some indicators, tools that you don't understand where they're coming from. It's important to understand why was this markets or why were these tools created. If you look at research and try and look at research for moving averages, in the stochastics, RSI, pivot points, or whatever indicators you use, most of you do not know. You just came and you take GBP USD and you start putting indicators left, right, and center, and you don't really understand what it was made for and what it actually does. You need to take a little bit step back in history and understand where it's coming from so that you can come and also use it in a proper way. Now, key levels and indicators, all this started back with the stock markets. Back then, if you do your history, before currencies came into existence, remember, the currency market was established in the late 20th century. Before then, it was a big bunch of stock markets. The first stock market was in the Netherlands, Amsterdam, and it was the Dutch stock exchange. You can do your own research and find out that. It was basically a market that was taking shipping companies that were really dominating back then in the Dutch. And this was, I believe, in the 18th century, 1700 and something, 18th century, give or take. And that's where the stock market began. And slowly, as advancements came, people started creating these indicators and started using them in the market. Only when markets became digitalized is when now we started seeing the creation of this digital format of indicators, and a bunch of them came out. If you go and look at indicators, there's millions of indicators out there. Everyone keeps creating indicators, but they're the major basic ones that we want to look at. Now, what I want to talk about today is key levels, but key levels is not an indicator, do not get me wrong, but you need to understand how to use them correctly. I have personally been using them for long, but this time of late with my backtest, it has become, especially if you're trading indices and commodities, and with a major focus on indices, using key levels is mandatory. It is much bigger than trend lines. It is much bigger than any trade pattern. It is much bigger than any indicator. Key levels is used by institutions, used by hedge funds, used by mutual funds, used by the big players to trade in the financial markets. Now, a little bit of history. If you look at history, what are key levels? Key levels are specific price points on a chart where significant market reactions have occurred, such as major turning points, breakouts, and consolidations. This include support and resistance zones, what we mostly know, round numbers, which are psychological levels, especially on commodities and indices, previous highs and lows. I tend to use this a lot. These are different types of key levels. I tend to use this a lot. So for me, previous highs and low tend to act for me as very good key levels. Daily, weekly, monthly opens and closes. Okay, most of you may not know that, but these are also key levels that you need to pay attention. If you watch CNBC or Bloomberg news, you'll tend to hear them talking a lot about market is retesting the monthly open, the monthly close, and such stuff. Quarter levels, this is what Ken usually uses. For those traders who've learned a lot with us here, already know that the quarter levels, if you watch Ken's videos, he's talked a lot about them. And high volume zones, order block regions, and most of you are ICT, SMC traders, and you use a lot of this. So it just depends on your school of thought, where you've learned how to trade. They serve as reference points for future price behavior, acting like invisible magnets, where it tends to pull the market to that level that attract, reject, and trap prices. You'll see later, I'm going to show, during this level is where you're going to see a lot of volume and volatility. Just because market has come to a key level and a lot of fluctuation, and that's what I'm currently experiencing right now with the Dow Jones and the indices right now. You can see market has come to sort of a level here. Okay, now like I said, I use a lot of support and resistance. So this level here, okay, let's get this one here. Okay, so if I extrapolate this, it was a previous high. Let's take it as a zone. Okay, remember, key levels for me, I take it as a zone, not necessarily a line. It's that if you put it as a line, you're sort of looking for perfection. So for me, I take it as a zone. You can see this was a previous high. Okay, broken, became support, pushed to a new high, came again to a support. Now you're seeing there's a lot of volatility here, because as market was dropping, this whole drop was like it's like a vacuum where market can't. I wasn't expecting any support level, but at this level you can see market broke below, broken above, coming here and still playing around this level. It's a very major volume area where market has been attracted and is sort of like trapped around that region. Okay, and not all the time market coming into a key level is going to be trapped. Sometimes market will come and immediately bounce above or break below or whatever. Okay, but in this case we're sort of seeing market is sort of in a trap price, which is good. It gives indication that many orders were there, many people were looking at these prices, many people are looking for entries here, many people are looking for take profits here, and some people looking for now those entry levels to enter the market. So now, brief history. Early price action observations pre-1950s, before the digitization of the markets. Before indicators like RSI and MACD were invented, price itself was the only tool. So as much as we're using indicators, okay, or key levels, remember, at the basic level, before key levels come to play, before anything, it's the existence of price action. Early tape traders and floor traders will watch price tick by tick and notice patterns around specific levels. Price will bounce off previous highs or lows. Repeated reactions will occur at whole numbers. If you read Jesse Livermore's story in the book Reminiscence of a Stock Operator, you'll get to see that he shared a couple of strategies that he used to use when he was trading the commodities, the gold, cocoa, and such markets, the wheat market and all that, the pigs market as well. It's a vast market, and he used to use a lot of these whole numbers, and those strategies still work to today. This led to the development of price-based technical analysis. That is where it began, which became formalized in the early 20th century with Charles Dow and the Dow theory. If you've gone through my course and if you watch my videos, I talk heavily about the Dow theory, emphasizing on support and resistance and market structure. And last but not least, now in the 1970s to 1990s, with the rise of institutional trading and pit trading, large traders and investment banks began relying heavily on price levels to execute large orders without moving the market. Banks will place limit orders and stop losses around numbers and previous highs and lows, creating predictable liquidity zones. This is where the concept liquidity pools and stop loss hunts began to enter the trading vocabulary. Okay, so it's important for you to understand where we're from. Those are part of what I use. I've also started incorporating moving averages, and I'm doing a lot of research on that. Now, these are things I read a long time ago, but I read them and I just had the information. But right now, I've really brought back the key levels heavily. Okay, I've always had them, but I've gone deeper. Moving averages, I've gone deeper. And I'm also starting to a little bit, this is sort of a hint, also to incorporate Elliott waves, and I'll talk about this in a different video. If you watched my videos long time, or if you've been a follower of ours, I used to be heavily Elliott wave trader. I tried trading Elliott waves using the currencies, and trust you me, I don't think they work well in that market, and I've brought them back. So I did away with Elliott wave, and I did it. I was a heavily Elliott wave trader. Now, coming back to stock market, I remembered my lessons and what I learned, and I started seeing while I was doing backtesting, why am I not using Elliott waves? So I've started incorporating them back slowly, and sooner or later, once I get a good understanding and in this market, I'm going to reveal it to you guys and show you how I trade that. But at the same time, most of these secrets and what we do properly, I share them in our course here at Financial Hub. So it's best for you to take up the course. We've really slashed down our prices, so now our courses are much cheaper as they're fully online, and we want to take the trading to a better level by teaching you that using our course. So I won't reveal everything here. This is just to show you what I've been working on, but the tools and the research, the backtest data that I want to share is more or less in the course if you take up our course. So that's just a bit of update that I've done incorporating key levels. Just wanted to get deeper to understand where key levels come from, where they're mostly used, and how institutional traders use them to trade. But apart from that, I hope you've enjoyed. I'll be back with more content and share this with you. But like I said, take up our course to get the full in-depth understanding of how I trade the indices, because I will not reveal everything here. So I hope you've enjoyed that. And like I always say, stay woke, stay financially literate, and I'll see you in the next video. Peace.